student loans were supposed to help people move up in life. Go to college, build a career, earn more in the future. But for many Americans, the opposite happened. Student debt in the United States is now more than $1.6 trillion. About 1 in 6 adults carries this debt. And for many people, it changes major life decisions. Buying a home, starting a family, saving for retirement. So how did a system meant to create opportunity turn into something many people feel trapped in? The student loan system did not appear overnight. It was built slowly over more than 60 years. Each step had a clear goal: help more people go to college, expand opportunity, support the economy. But over time, several forces started interacting with each other. And together, they created a system where debt can grow faster than people expect. To understand why student loans feel like a trap, we need to look at a few key forces. How the loan system started. Why college prices exploded. How interest grows behind the scenes. Why this debt is hard to escape. And why some schools took advantage of the system. When you put these forces together, the picture becomes much clearer. The system began with a simple idea. Education helps a country grow. So the government tried to make college more accessible. At first, the system relied heavily on grants. Grants are money students do not need to repay. But over time, the system shifted toward loans instead of grants. And that one change reshaped the entire system. The first federal student loans appeared in 1958. The United States had just seen the Soviet Union launch the Sputnik satellite. There was concern that the country was falling behind in science and technology. So the government created loans to help train more scientists and engineers. A few years later, in 1965, the program expanded. The goal was simple: no student should miss college because of money. The intention was access, and loans seemed like an easy way to provide it. But giving grants to millions of students was expensive. So policymakers changed the model. Instead of lending money directly, the government encouraged private banks to make the loans. The government guaranteed those loans. If a student could not repay, taxpayers covered the loss. For banks, this removed most of the risk. It became safe to lend money to students with no income and no credit history. As a result, borrowing for college became much easier. Once loans became widely available, something else began to happen. College prices started rising rapidly. When more students can borrow money, schools face less pressure to keep prices low. Some researchers call this the Bennett hypothesis. The idea is simple. When financial aid increases, tuition often increases too. Colleges also began competing on prestige instead of price. They built new facilities, expanded administration, invested in campus amenities. Over time, the cost of tuition rose much faster than normal inflation. The next force is how the loans themselves grow. Student loans charge interest every day. But there is another feature called interest capitalization. This happens when payments are paused. For example, when a student is still in school, or during financial hardship. During these periods, interest keeps building. When payments restart, that unpaid interest gets added to the main balance. Now interest is charged on a larger amount. In some cases, the required payment is not enough to reduce the balance. So even when people pay on time, the total debt can still grow. Most types of debt have an emergency exit. Bankruptcy. It allows people to reset their finances if they truly cannot repay. But student loans are treated differently. Since the late 1970s, it has been extremely difficult to remove them through bankruptcy. Borrowers must prove severe and lasting hardship. In practice, this standard is very hard to meet. So unlike many other debts, student loans often follow borrowers for decades. The structure of the loan system also created opportunities for abuse. Some for-profit colleges saw a chance to expand quickly. These schools operate as businesses and rely heavily on student loans. Many charged very high tuition, but their graduation rates were often low. Students could leave with large debts and no degree. Although these schools enroll a small share of students, they account for a large share of loan defaults. This shows how powerful incentives inside a system can shape behavior. When you step back, the pattern becomes clear. Loans made college accessible, but easy borrowing helped push prices higher. Interest rules allowed balances to grow over time. Legal rules made the debt difficult to escape. And weak incentives allowed some institutions to profit from the system. When these forces reinforce each other, the result is a system where debt can grow faster than opportunity. Student loans began as a national investment in education. But over decades, the rules slowly changed. Access increasingly came through borrowing, and the responsibility for that debt fell on individuals. Understanding how this system evolved helps explain why so many people today feel stuck inside it. This is Simplexplain, complex ideas simply explained.